Okay, hello. Sugar my coffee. Cool. Okay. Hi, can you hear me? Can people hear me? Yeah, cool. Somebody can hear me. Okay, I'll just give it another minute for people to log in. At the start, the sound is kind of takes a bit of time for people to catch up. Okay, I'm gonna kick it off. I've titled this talk today, Lock in That Game. And I'm going to go through and explain, I'm going to highlight, I'm going to break down this presentation into 5 parts. The first one, I'm going to talk about the stock that I recommended selling today. And then the next 4 parts are some practical aspects to investing. My hope is that even if you don't agree with everything that I say, that there's enough here that you can take and use for your own investment style. So I recommended Arista Networks in January, and at the time I felt though I was $250 a share. I felt okay, things do well by summer 25, around something like $340 a share would be good. And I explained at the time that what I was looking for is this idea, this theme, that if you have a really strong balance sheet, it gives a lot of optionalities to the business. So last year I had recommended Broadcom, and it was that idea. It has a really strong balance sheet and it could do something. Okay, there was something that it could do with a balance sheet, and at the time I didn't know. I recommended, and then that optionality surfaced, which was them acquiring VMware. So it was the same idea here, but it didn't play out how I felt. It didn't really execute anything on the balance sheet, but it's that optionality that things can happen. And it's not that all my investments have this clean balance sheet. I previously sold AppLovin, and that did not. And you need to think about that. And also, an investment that I got now, which is Peloton, balance sheet isn't in the best shape. So it's not that all the investments have to have a clean balance sheet, but it's important just to think about that. Anyway, so I decided to call it a day today on Arisa Networks. Did a bit over 60% in 10 months. It was actually the 16th of January. I looked it up, so it's just 10 months. Quite happy that return. And this leads on to the topic that I want to talk about today, which is, the psychological aspects of investing. And a lot of people struggle with this. It's human nature. No one's born to be like a great investor. There's no such thing as being born to be a great investor. But you can spend a bit of time. So 2 resources that I recommend to, if you wanted to on your own time to follow up on this, would be Thinking Fast and Slow by Daniel Kahneman and Amos Tversky, butchering that name. And the other one is Super Forecasting by Philip Tetlock. So these 2 ideas, they kind of approach the problem in a different way. But essentially what you're looking for is you have a forecast, and how do you adjust for your biases along the way? So in my mind, the way I think about it is, that's, like I say, a little joke, that's the difference between being an accountant and being an investor. The accountant spends a lot of time going through the nitty gritty, and in my experience, the accountant has everything that they need to be like an outstanding investor. And it's really those psychological elements, okay? And that's what I'm going to talk about. So we are now, I call it the earnings season is really starting in next week because a lot of the tech companies start reporting there. Obviously, this week there's Netflix, and my businesses, the majority of them will not start reporting their results for 2 more weeks. So in 2 weeks, it's going to be brutal for me. There's going to be like earnings all over the place, and there's going to be a lot of me just running around trying to see what's happening. But I wanted to alleviate the portfolio, get some cash, some fresh capital, so that I can act on some stuff. There's a few names that I'm already done my research, already ready to go. But ultimately, the way that I phrase it is like this. So it's a saying in the market that stocks go up in stairs and they go down on the lift. So at first, investors are kind of apprehensive, not sure. It's kind of like they want to see what everyone else is doing. So it's kind of like this look to see if the story really plays out. And there's, a bit of let's see what other people are doing. And when stocks have negative surprises, they go down in a lift, because first there's that cool aspect of, oh my gosh, I gotta go, the pain of that. Secondly, it hits a lot of the stop losses on the way down, so it builds up momentum quite quickly. Often, particularly outside of the earnings report, stocks can go down quite abruptly, and you will see that it actually has nothing to do with the underlying business. The underlying business, the people are still, growing their sales, growing their revenues, but they're taking along. But the share price, can kind of really go, whoa, like crazy in a short period of time. And this leads me to the third point that I wanted to talk about is why I don't use stop losses. So if you wanted to, you can look at Arisa Networks, the stock I recommended to sell today. And along these 10 months, there have been so many periods where this stock has been down 20%. Like, oh my God, like it's been like brutal. And the way that I see, okay, let me say an example of an investment that is not working out for me, because I always like to talk about those investments. First, it creates transparency, and transparency builds loyalty, but also it bores me when people just talk about their winners. I just can't stand this. Like, I get like migraine. Like, talk about the losses, and the lessons learned there. That's much more valuable. Anyway, so the way I see it is I want to try to make an investment in the business. So I've taken control of a portion of that business. Okay, so I've got the shares, I've got the proportion of that business. But people say, oh, I just walk around with 20% stop loss. Well, the 20% stop loss is saying essentially, hey, broker, Mr. Goldman Sachs, if you want my business from me and you want it cheaper, just make a little bit of volatility and you can have my business. And it's mad. It's completely mad. It doesn't protect you as the investor from anything. It protects, yourself from gaining that upside. And it's difficult. I get it. I really recognize that. So coming back to, let's say, something that is not working out for me right now is Money Lion. So the stock I recommended was originally a very successful investment. It did really well for me. It went from about $18 to $70. I was like, wow, champion as well. And then it went from 70 to 35. So poof, down 50%, brutal. But in that period, it's been less than one earnings report. So yeah, okay, I made a mistake here. Perhaps you can say that, I should have sold at a higher price, but I want to base my decision to sell my business on my investment decision. So I want an investment decision. I want it to be a sensible decision of why I'm selling that business. rather than some kind of knee-jerk reaction. I want it to be a data-based decision. So I find that that's quite helpful to think about, because you know it can be brutal. Like it's things happen all the time in the market that have absolutely nothing to do with the underlying earnings of the business. And I believe strongly that you have to. This is my point 5 of my presentation. You have to make a decision when you are investing whether you want to be an active seller into strength or selling into fear. Okay, so you can make a decision. Okay, I don't have a stop loss, but the share price is doing well, and I can sell into that strength. So it's at that point in time, it's the maximum equity that's been represented in the share price. So the market is giving me, at that point in time, when I'm selling the strength, the maximum return on my equity. So, okay, you don't know what's going to happen tomorrow. And when the market is particularly hot, like it is now, you are lulled into believing things that are not true. I've seen this time and time and time and time again. And I've seen it on both sides of the equation. I got a lot of followers, and I see the comments, and I see when things are hitting the fan, like it did in July and August, people are really nervous, and they think that it's just doom and gloom and it's going to last for a really long time. And it's people feel like, oh, I'm going to wait for a better time to get involved. And when that better time comes, which is now, people are like, oh my God, what can I buy? And I'm like, dude, like you need to work to preserve your hard-earned savings. So the way I think about it is, okay, how many hours did I have to grind to get this amount of saving? And if I calculate that, and I'm like, okay, do I really want to give up those hours? Because I'm not getting any younger, and I think to myself, okay, I can't go back in time. I can't print more time. I can print more money, within reason. I can become a successful investor, but I can print more money. I can't print more time. And that time that I put in, that grind, that blood, that sweat, that tears, those tears of me getting up, grinding, sleep deprived, that time I think, okay, I need to preserve that capital. And that's something that everybody can take away, whether you are a day trader, the world's longest long-term trader, whatever it is. You need to always work on the principle of making sure that those savings reserve the power, the purchasing power that they have. So this is my final point that I want to talk about in the presentation today. What's really important is when it comes to outperforming the market is to have a process, okay? So have a crystal clear process. Now, for me, I'm in a very lucky situation that I come here every Tuesday and I explain my inflection investment strategy. I have it nailed. I know exactly what it is. But maybe your strategy is different, right? Maybe you are like, someone's telling me, oh, they want to go long, short, this, that, the other. That's fine. Whatever you want to make in your soup, that's okay. But just make sure you have a process crystal clear. Not like, oh, what I feel like, be very objective, be very critical, and be moderate. And, you can either try to be sensible or the market can make you more sensible and humble. So having a clear strategy and being able to summarize it in 2 or 3 bullet points for yourself, writing it down on your piece of paper is really, really important. You can put a Google spreadsheet up for yourself, so you can always on the fly check it for yourself, but know why you're getting involved in certain investment, because every investment is a bet. You can pretend to be something else, but it's a bet. You're making a bet, an assessment of what the future outlook of that business's prospects will be. Okay, like you haven't got a clue, but you're having an assessment of what that future is going to develop like, and there's a range of outcomes, and no one knows how the outcome is going to be. Like when Buffett was buying the airlines, he didn't know the COVID was going to be around, but if you look through the cat reinsurance that they have, it was definitely something that they, Ajit and Warren had talked about. So, it was something that as a possibility on the cards. So there's a range of outcomes, okay? Even if you're the most successful investor, it's never clear, okay? It's clear in hindsight, but you have to invest with the cards you have right now. And it's always incomplete data that you have. Don't think that I got this. Or the one that really triggers me up is when people say, oh, the stock is down 25%, therefore it's a great investment. Where the stock was has absolutely no implications to where it's going to go. So have a strategy for yourself. So for mine, I like to follow the free cash flow of the business. This is something that I'm very, very objective and critical about, but have a strategy for yourself. And I hope that this has been helpful. And I'll open it to some Q&A. Yeah.
Hi, Michael. This is Rob. I have a question for you. You were recommending a sell today because the stock went up. I've been following your advice and letting my winners run. And I know that you just said, everyone talks about their winners, so I don't know what to do about my losers. But I have Affirm, Hims, and Robinhood that are all up over 50% in just a couple of months. So I know that you haven't recommended Affirm yet, but you and I have traded on. My question really is, and the market is at its all-time high. Should I just continue letting them run, or like with Hims, I do expect the stock over the course of the years to go up, but it's a very volatile stock. It kind of, it like goes from, I don't know why, but it goes from like 12 to 20, right? So I just didn't know whether I should just keep them and let them run, or if I should take any action. And that's really forgetting about my particular ones, any stock that's up over 50% in just a couple of months.
So in the past, I used to have a different trading strategy. I would let those winners go a bit longer. Like the example that I gave was Palantir, AppLovin. I would let those things go a bit longer. Now, I am biased. I cater a service to people, and I want it to be an easy decision. Like follow my trade blindly, buy, sell, blah, blah. Now, you mentioned three companies, and I'll go through all three. So in the case of Affirm, I regret that I didn't buy this. The best investments that I've ever made, I think, okay, that's an exaggeration. Some of my best investments have been when I've gone from being bearish to next quarter being bullish. Oh my God, this is like the cash register for me. And this was like my setup. This was my setup. And I had a lot of stocks in the portfolio. And I just was like, okay, you know what? I don't have free capital. I'm going to just bounce this one out. And that was a mistake. So I like businesses that, I know we talked about this before. I like businesses that are inflecting to increased profitability more than the market expects. So everybody that doesn't really know Affirm often refers to Affirm as an unprofitable, I'm not going to say the nasty word, but yeah, there's basically, people have a certain reputation, Affirm. But actually, at the end in 12 months, less than 12 months probably, they're going to be gap profitable. That's going to change the whole narrative here. And that type of setup, I like to kind of think about. Now, in your case, if you're at 50%, personally, the way that I'm doing it nowadays is I'll just call it a day. But Affirm today is not very expensive. So I feel like it's about 17 or 18 times for operating earnings, growing at more than 30%. That's not bad. That's really, really cheap. So I feel like, I don't know how comfortable you'll be with this, but perhaps sell half, wait another quarter or so, quarterly earnings report, and sell the other half. Yeah, so Affirm is not a stock that I have in deep value returns, but I know this business really well. Robinhood, okay. I am waiting for $30 a share, simply because this is what I've been saying to everyone that I'm going to wait for. But, if you already, it's very close now. It's around 26, 20, I don't know, even like it's around $26 now. It's really, really close to 30. It might not make sense for me to even write it into the earnings. It might just not make sense for that. So I might even very soon call that a day too. Hims and Hers is a very volatile stock because it's highly followed by a lot of retail investors. It's a bit like, in a sense, like Palantir, like that. Some businesses just seem to catch the eye of retail investors, and that's why it's so volatile. And that volatility is something why your person is paying a smaller premium than you would otherwise. If this was like ServiceNow, people would be paying like north of like 100 times for free cash flow. Like it wouldn't even matter. Like you don't even need to make any free cash flow. But because it's got such a high retail following and it's so volatile because all the retail emotions, weekends, blah, blah, the premium is quite small. So yeah, it is a cheap stock. There's no point. I don't think that many people would objectively say that the stock is expensive. We can get into the question of whether or not the weight loss GLP-1 has any future economic value or not. I would say it does, because even if it's a commodity like business, yeah, commodities like oil, yeah, it goes up and goes down, but it's still worth something. Now, it's never going to get a premium that makes sense. So I've been recommending stock for a long time, and I feel like $30 a share is enough for me to call it a day. But as you said, it is really volatile. And, I in line with what I'm talking about today, I don't want to overstay my welcome. So
Right.
You have to be really, really careful in the market, and I don't want this to come and bite me afterwards, but I know that the market is really, really hot right now, and it wouldn't take a lot for the market just to kind of fizzle out really quickly. So I will keep holding this until 30, but I am very, very much aware that there's no free lunch here. And if, you're saying, okay, if you happen hypothetically to be at 50%, you may be interested in cashing some of that in. There's going to be so much opportunity now. So as I said, in 2 weeks more or less, the small caps start coming in, and I know there's going to be loads of stuff happening. I know that's like there is going to be so much stuff happening. So yeah, it's kind of a bit of a wishy-washy answer, because I on the one hand I'm long, but on the other hand I'm saying to you, okay, if you have a certain amount of gain, you might want to kind of be a bit prudent about that and think about capital preservation in the first instance, because there's always something else. There's always tomorrow. There's always an opportunity tomorrow. There's always. Yeah.
Right. Okay, thanks.
Okay. Would anyone else like to ask any other questions?
I'll just mention this. That with what you were just saying, for example, Hood, then if you have maybe 3 stocks that you say, you know what, these are getting ready to go well, hey, just wouldn't that be the right time to say, okay, we've done enough here, let's update and we'll get more potential on this other stock?
Yeah, yeah. So I feel like, that's why I'm trying to be quite clear with everyone. Like, this is the price target, because I don't want to kind of surprise anyone. This is what I thought. Like, I want to be quite consistent to my messaging and explain and get everybody along the board. That's why I kind of have these price targets, because some people, like you, George, very active. And other people, they have full-time jobs and this and that and the other, family commitments, and they don't have as much time to spend on deep value returns. So I kind of want the messaging to give enough people that are not so active, time to digest the information.
Okay, thank you.
Thank you so much for coming, George. Thank you. You're very kind. Any other questions?
Yeah, I have one question. When I see a recommendation from you, how do you buy? Like 5%, do you buy at once, or you buy several times? Or what's the timeline you try to buy them?
Thank you so much for asking that question. Hi, Bayan. So the way that I explain this is like this. So when I recommend a stock, I say, generally, I explain, buy 2.5% of your portfolio. okay? Then you wait about 4 to 6 weeks and you put the other 2.5%. And the reason why I do that is to give people an average price, because between buying it and the next 6 weeks, there will be a better opportunity. There will be. There's always a better opportunity. So it's really, really important to not go all crazy, you know, because when you've been with the business and you have a portion of the business, 2.5%, you get to know a bit more about the business. It's like in your subconscious, you're kind of thinking about it, and you're like, oh, I wonder if this other business relates to that, and how, and you're kind of building a mental model with time. So the reason to separate these out into two purchases is that to really just give a better price point, but also to build that conviction in that period of time. I try to, if I can, to follow up. So after I recommend something within like a couple of weeks, I try to kind of follow that up with another one, just to kind of say to people, hey, listen, there's this new idea here. I hope you haven't forgotten, because there's a lot of emails going through about me, like in different things. So just to kind of resurface the idea. I genuinely believe that when I find something, obviously I make mistakes. You know, I explained money line, I made a mistake, overstaying. But generally speaking, I have a good batting average, and it's kind of better to buy at the start. And, you know, I find that the biggest return comes with the time holding that stock. Not necessarily timing the stock, oh, I got a great price today, but just the time. And you saw, like, I don't know if you know, but Gig Cloud Technologies kind of go up, goes down, goes up, goes down. And now I'm kind of, again, looking at a small profit, not much, but a small profit. But it's just really the time that I've held it. It's not that something miraculous has happened to the business. It's not that I had really smart insights to time the stock. It's just really, you know, the time in the stock. Any other questions? Okay, I'll just ask if anyone else has any other questions.
I think you answered one of the question already, Michael, when you mentioned about not timing the entry, because I was thinking LEU went up like really, really fast. There was a huge jump. So I was just waiting for it to normalize a little bit. So yeah, but I'm interested in that one and UEC.
Okay, so these two are very, very different. So they're kind of related because they both to do with the uranium thesis. Centrus Energy, LEU, was up a lot before I kind of got familiar with it. People had told me about it, but people tell me about a lot of stocks. I kind of, you know, my job normally is just to say no to people. And I, you know, it was kind of percolating in the back of my mind, and someone said, oh, you know, you're an idiot, look at this again. And I was like, okay, like, I'll look at this again. And I looked at it, like, oh my God, yeah, this makes total sense. So it had gone up a lot. The moment that I recommended it was already up a lot. But I don't know, it might go up a lot more. So it's, you know, it's this kind of timing stocks, man. It looks really great when you write up a book and you're like, oh, if you bought this and you sold this and you're a hero, blah, blah. Or if you bought Netflix at the IPO. But that's fiction, man. Like, generally speaking, as long as the multiple makes sense, it doesn't matter whether it was up a lot, like the months before, or down a lot. Just, it's really the time in the stock that really, really drives your return. Obviously, there are...
So the CAGR, which, sorry for interrupting, the CAGR which you have as a column in the spreadsheet, is that the indication for the time in the stock? Right.
CHER, what's that mean?
No, CAGR.
Oh, the CAGR. Yeah, no. Thank you for asking that. So the compounded annual growth rate is that some people want to know what kind of growth rate is this business growing at. So, for example, Peloton has no growth. So it's kind of like, okay, oh, sorry, my wife. So Peloton has no growth, so that's why the CAGR is really, really low. Whereas something like Intuitive Machines, I believe that next year they're still going to grow at 200%. So that's what that means. The compounded annual growth rate is the revenue growth rate for the business, not necessarily anything to do with the time in the stock, anything like that. It's just a fundamental bit for what's the growth rate of the business.
Got it. Thank you. I thought the 200 was a typo error, but I'm glad you confirmed it's correct.
Yeah. Thank you for asking that. Thank you so much for asking that. About Uranium Energy Corp. So Uranium Energy Corp and Centrus Energy, LEU, the Centrus Energy, is an enricher. Okay, so you need to get the uranium out of the ground, that's the miners, and then you kind of move it up and you sell it to an enricher. That enricher then has to get the low quality of uranium, enriches it up, and sells it to a utility or a small modular reactor. That's why, incidentally, I actually, believe it or not, I have been saying for like a week already, how long until Google comes up with their own solution for this whole nucleus story. And like, as I was saying it, they were like writing the contract right there. So, you know, all these hyperscalers need a lot of power. The way I describe it is like this. So I said this last week, I'll just remind people who haven't listened before. The amount of energy that it goes from, let's say, having a handheld calculator to a desktop PC, that jump, that magnitude jump in energy is the same as desktop PC going to the cloud. And the same jump is going from the cloud to these AI data centers. It's extremely power intensive. So the contract that Google has with Oklo is for 500 megawatts of power, and this is about the same as around about a small town of 400,000 people. Well, for small depends on, you know, if you're in Britain, 400,000 is quite big, but if you're in other places of the world, like 400,000 is not, it's peanuts. But so you need a lot of power. 400,000 houses, you can do a lot of stuff with 400,000 houses. So it's a lot of power that Google themselves need. And obviously, then you're going to have Amazon, you're going to have Microsoft, and, you know, give it a tiny bit more time. Who else is going to need? You know, Oracle maybe. Like, there's just so many different people that are going to need access to this always on baseload energy. So I had this idea 2 years ago. It was my idea. I stole it. I stole this idea from Buckle Smil. You know, I took this idea, and I've for 2 years been sat on my farm, and it has been like a complete underperformer. And, you know, if I didn't fully capture this trait, now that the idea is actually taking place, like, what am I doing in my life? But at the same time, I said it many times in the school, it's really, really important to think about the capital preservation, okay? So I don't want to go all heroic on this, like, oh, like, you know, you always have to think about every investment is a risk reward. Every investment, there's a likelihood that you're going to, no matter how smart you are, there's something that's going to go wrong. So you need to work on that principle that if you invest like I do, you don't have any stop losses, you need to give these things time. And, you know, you don't want to all your eggs in one basket. Yeah.
Michael, do you increase your percentages when you see that a stock is directionally moving up pretty good and will continue to do, I mean, based on the slope of the price, will you add to your winners and remove from your losers in small portions? Or do you just always keep a 5%?
Always keep it at 5%. And there have been times where, you know, I always try to buy at a cheaper price a second time. I always try, it's not always that I'm very good to timing these things, but I try and get a cheaper price than I did the first time I bought it, the first thing. The second thing is sometimes these businesses actually make a comeback, like Enovix, you know, it was trading at like $8, now it's back to about 11 or 11.5. So, you know, I try always, if I can, to buy at a cheaper price. As long as my confidence is still very, very high for that. So for example, with him, there's been so much chance here to buy at a cheaper price. It's easy. It's been easy. But other businesses that have been very clear about like Moneyline, I'm like, okay, let me just wait. This will be plenty of time when those earnings come out for me to make a decision. Yeah.
One last question. Sorry, I don't mean to ask all the questions. Apologize. One last question. The target price which you come up with, is that based on future revenue, future EPS, or some other metric which you use to estimate the target price?
Okay, so the simple answer is nowadays I'm just going for about 50% higher than it is today. That's really just a simple answer. But generally speaking, and I don't put this on my articles, is I have a very good sense of what that typically goes in the market. That's really my experience. This is like the one thing that I'm actually quite good in my life is that I follow a lot of businesses, so I have a really good sense of what makes sense. Does it make sense to me? Would I be willing to buy this business if it had this amount of free cash flow? And if I feel that I'd be willing to buy it, then I feel that someone else is going to buy it too. So I don't discuss that aspect, not because it's a secret sauce, but I just think about that. That's really the only thing that I would say in my life, apart from taking care of my daughter, that I'm really, really good at, is having a good sense of what makes sense in the market. That's why I have a very niche number of followers. People say, oh, have you know this stock? How do you know that stock? No, I follow the stocks that I really like and aspects that I really like, and I stick very closely in that little bubble.
Thank you.
Okay. Thank you very much, everyone. Really appreciate you coming on and asking questions. And I really hope to see you next week. Thank you so much. Bye-bye.
Yep. Thank you.
Bye.